And I've had 2 conversations in the last 3 weeks with people renewing that their home's worth less than what they bought it for, which is crazy. I don't think that I've ever had that conversation since we started in mortgages like 15 years ago.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello, and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson, joined as always by David Warren. We are both level 2 mortgage agents, and Dave is the owner at Referral Mortgages, and we're back, baby. We missed last week. It was a very hectic week. Dave and I were both out of the office, so we apologize for the lapse, but we're back. We're ready. And the Habs have made it to the conference finals. It's my brother's birthday today. Happy birthday, Tim. I don't think he even listens to the show, but I'm going to say it anyways. And Dave, how are you doing? How was the weekend?
I'm doing well. Like we were saying off air, I was solo parenting the last weeks. Made for a little bit of a hectic, long weekend, but it was good. Got out and about. Got to a Titans game yesterday. Got to a Red Blacks game that Open Fan Fest thing on Saturday. It was good.
Mm-hmm.
Out and enjoyed the weather.
I have to mention too, speaking of the Canadians, the women's team, the PWHL, had their they're in the Cup final. I'm not sure what the name of the cup is. They won last night though. I was pretty excited. I saw the highlights this morning. Record-breaking crowd at the Canadian Tire Center. I think it was 17,500, and they scored in the last minute to win the game. So now 2-1 in that series. Best of 5. Let's go Ottawa. Let's bring a cup home. We haven't had a cup in a long time. Dave, speaking of headlines, okay, we had the stats come out recently for April, and this was we've been talking about the numbers, right? And we were kind of waiting to see what the numbers would look like. I did a full comparison here for April and March, just so we can see the contrast. And I'll zoom in on April just so we can take a look at these quickly. So here we go. New listings in April, 3,258, and that's up from March, which was 2,452. So an extra 800 for the month of April. The benchmark price, single family home, 717,000 versus 698,000 in March. So a little bump up there for prices. Days on market, exactly the same. 3 weeks, 21 days, which I'm actually very surprised at. I thought it would be much higher than that, with just what I'm kind of seeing, what I'm hearing. Most realtors I've talked to, they're saying their listings are sitting longer than they were kind of expecting them to, like really hot properties. They list them, a lot of attention, and then kind of stalemate for weeks, So 21 days still seems very low, but I think that's kind of the contrast. There's some homes selling in 3 days, and there's other homes sitting for months, and that's the actual average is 21, but there's a really strong contrast there. Active listings, 4,535. That's up from 3,500 last month. Benchmark for apartments, 379,000. And that is down from 384. And the number of properties sold was 1,336 in April, and that's up from 1,075 in March. So what are you seeing here, Dave? Anything in here, again, standing out, anything that's kind of eye-opening or that surprises you outside of the days on market?
Number of new listings. I mean, really that 800 increase is effectively a third increase, like a 33% increase over last month, which is quite a big uptick in listings. And just looking at the graphic of April only new listings, that this year is the highest number of April listings since pre-2016. I mean, 2016 was the highest at 3,217, and we're at 3,258. I would imagine that based on a third, like 35% increase in listings, March to April, that we'll see that days on market tick up. I would just imagine with that much extra inventory, properties sold. Yes, it did tick up from 1,000 and change to 1,300. So obviously, a little bit of an increase there, but not enough to absorb that much inventory. So I would think that we're going to see that days on market jump up dramatically next month. That would be my guess. And that's the biggest one that stands out. Aside from that, kind of secondary to that is back to 717 on benchmark pricing, being sub 700, 698 to be jumping up almost 20,000 and over 1 month is pretty dramatic. But again, kind of speaks to the market picking up a bit. Obviously, again, going from 1,000 and change property sold to 1,330 is again it's a 30% increase in activity of properties sold. So it's kind of, that's telling of seeing some of those properties go multiple offers or increasing. And I have still been hearing of that. That's not, I know we haven't spoken about it in a long time, but there are still the odd property that is getting multiple offers. I was speaking to some realtors over the weekend that were talking just exactly about that. Places sitting for, 3-4 weeks, and then like boom, what do you know, getting a few offers on it weeks after being listed. But yeah, those are the two that really kind of jump out to me.
Yeah, Francis talked about that when you were away a couple weeks ago, and Francis was on Abrel. She was talking about how like that's exactly what's happening is that, there's no bites on the property, lots of interest. But then when they actually do get an offer, 2 or 3 people that were interested kind of flood back in. And that kind of happens. It's not that uncommon for that to happen. But I do think that there is still, I think sellers are still expecting more than what their home's actually worth. And there's a lot, there's a lot to unpack there. There's a lot of reasons for that. But I think seeing this uptick in price is quite encouraging, to be honest. However, with the rates where they are, my fear is that there's going to be even more listings because as people come up for renewal, which we know there's a huge bulk of renewals coming up this year and next, that we're going to see even more listings with people coming up for renewal and saying, well, you know what? We don't have to do this, right? Let's sell this place, maybe move outside the city or even rent or kind of readjust their financial picture. And I think over the next 5 years, we're hearing all this stuff about, and I don't want to get too far down the road of AI, but with everything becoming automated and jobs becoming more scarce, and even like businesses with their new hires, kids coming out of university, Jensen Huang, the CEO of NVIDIA, was saying recently that like if he was to hire someone out of university, he'd be sooner to hire someone who's an expert in AI than someone who has a master's in mathematics from a university, from Harvard or something, which is crazy to think. But that's just where the economy is going. And the reason I'm saying this is because the next 5 years, I think, are going to be completely unprecedented. We're going to be living in a brand new world. And I think the economy in general is going to shift dramatically. Dave, we had a funny bet, a decade ago that I was joking saying that the stock market's going to be completely different. And like, the stock market won't exist in 3 years or something. Now, maybe I was a bit ahead of my time then.
Thanks for reminding me. I should collect on that money.
Yeah. But all this to say that like they just passed in the US that they're going to allow like tokenized investments into companies. So they're going to be using like the crypto exchange and stuff to be able to invest into companies. The stock market as a whole is going to be shifting. All these companies, like even the president of Citadel was saying over the weekend that their top trading people are now, it's basically agentic AI that's doing the algorithmic trading for them. Like they've gotten rid of all of their best people. He even said he was depressed thinking about it because they have the smartest minds in the world that are no longer needed because there's all this AI that's coming that can basically replace them easily. So I just think that the next 5 years are going to be unprecedented as far as how the economy looks and what we look like. And I don't think Canada's necessarily in the best strategic position right now, currently, and I think we can be. But I think all of this plays into the real estate market and, bonds being higher right now because of what's happening overseas, oil being higher, the cost of living being higher. I think people are really taking a step back and looking at their their total financial picture and saying like, where do we want to be in 5 years? Where is the world going to be in 5 years? And trying to position themselves in the best way possible to be able to pivot and be able to, I guess, navigate that new world in the best way possible. And I think right now with all these kind of new listings and rates being higher, I think it's creating that opportunity right now where people are thinking, what do we want to do right now with this property, right, at renewal? And I'm not saying that's necessarily the biggest catalyst, but I think we will see it more and more. And especially now in this next 18 months where there's a lot of renewals coming up, I'm very interested to see what people decide to do. Are they going to renew? Are they going to refinance? Are they going to downsize, upsize? Like I'm interested to know what's going to happen because, as I said, it's unprecedented. So like there's no historical record of AI coming in and disrupting all these industries and all these economies. So what do you see happening, I guess, over the next 5 years? And what do you think is kind of the biggest catalyst to those new listings?
I think the new listings are people coming up like this past week. They're finding that the buyers are buying out of necessity, not out of desire, in the sense that they are having to move. They are out of space, and it's not out of desire in the sense that like, oh, it'd be nice to have a bigger yard, or it would be nice to have a bit of a bigger place. It's like, you know what, we can make this townhome last longer because we're unsure about what's going on globally. What used to be closest trading partners to the south used to do, or our relationship there, and that kind of bleeds into it. But a lot of those buyers that they're finding it's out of necessity. And then from a listings perspective, a lot of people with rentals listing, that are coming up for renewal. A lot of those listings are where they just say, you know what, my tenant's month to month. I'm going to put it on the market to see if I can unload this because the payments are jumping dramatically. And, and I've had a couple of clients where they know that they can't sell the property. It's a rental. They know they can't sell it right now because they're mid lease on it. And on their renewal, they're jumping up and they're going to be in the hole $300 to $500 a month based on what they can charge and what their mortgage payments are going to be. And so they're like, you know what? I'm just going to go short term and I'm going to hope I can sell this in 2 years. And basically going to take that loss, take that tax deduction on their, tax return kind of thing. But a lot of those listings are finding that they are like, again, almost out of necessity. Those listings, those purchases are out of necessity, not just desire. And the people that are sitting on the sidelines of home buyers are kind of in the same mindset. Like unless, first time home buyers or people looking to get into the market, there's so much fear that they have of their employment, whether they be like an Ottawa government. So there's still some shakeup to be had there. And, or from private employment, we're seeing people being laid off. We're seeing the high unemployment rate in the people in their 20s. So they're not able to save or they're just unsure about what's going on. And I think that's going to continue right now. And people, there's a great article, I forget where it was that I was reading, but it was more like people want to jump into the market out of fear of missing out, as opposed to when prices are coming down or stagnant. It's just like, same with the equities market. Like people just have this mentality of like prices are going up. Like we have fear of missing out on that gain that they're going to have, as opposed to let's buy strategically. And I remember years ago, we always talked about like when people were paying 100,000 over list and things like that, of just like, you shouldn't be buying for the here and now. Like you shouldn't be buying out of speculation. You should be buying for what you're going to, where you're going to need going forward, and expect that you're not going to be making a lift in that home price based on what you were paying. And we're seeing exactly that. And I think that's what's keeping people on the sidelines as well, is just that being unsure of things. Prices aren't increasing dramatically. There's not a flurry of activity. It's not a flurry of, news articles talking about real estate in the market. And so they just, they're content with renting instead. And people are also struggling for making ends meet, let alone being able to save money for a down payment.
Yeah, I think that's a very good point. And I think also like right now with where prices are, like if you're an investor, which, if you're a mom and pa that want to have a rental property, as you're kind of mentioning, those people coming up for renewal are potentially selling that property. It has to make sense from a cash flow standpoint. So if rates are higher, prices are higher, rent isn't quite like rents actually come down, I believe, in Canada. I think it was the 7th month in a row or something last month. I don't know where it is right now. But rent's coming down, home prices are going up, interest rates are up from where they were even, 3-4 months ago. So it just doesn't make financial sense for anyone to be buying these properties as investments. So it is pushing more people into potentially renting or maybe just owning their primary home and not even considering real estate as an investment opportunity, and instead going into maybe the equities market or an ETF or something like that. So I think there is a shift into how people are investing, as you mentioned. And I think that real estate is just not, as you said, as attractive. Like it's more of a purpose-based purchase, which I think is actually good. Like long-term, I think that's actually good. We talked about like 2020, 2021, how many people were buying speculatively, being like, well, we're just going to buy because the market's just exploding. And they bought something. And I've had 2 conversations in the last 3 weeks with people renewing that their home's worth less than what they bought it for, which is crazy. I don't think that I've ever had that conversation since we started in mortgages like 15 years ago. Like, I think this is the first time where we're going to see people that bought at the peak that are now selling into like a lower market and having to, because they need to adjust their financial picture. They need, to alleviate themselves of some of that debt or whatever that looks like. But it's wild to see people like I talked to a client and I won't talk specifics, but basically they had less than 20% equity. And I said, we were talking about rates and this, and I said, so your mortgage was originally insured. And they said, no, it wasn't. We actually put 20% down. And that's where I was like, holy shit, like this is real. Like they put 20% down and now they have, 12% equity in their property. So like they've literally taken a huge haircut and are selling now, and they're going to be paying fees, and they're selling on renewal. So there's not going to be a penalty there. But all this to say, like there's a lot of people out there that bought in the last 3-4 years that bought at the peak and are now having to, again, like adjust their overall lifestyle and their structure because they're basically losing money every month and they just can't afford to continue doing that, with where things are. And if they renew into the fixed rates today, which I think all things considered, like historically speaking, like 4.5% is not a crazy high interest rate. But when you're renewing into that from 2% or 2.5%, like it's going to have an impact on your family household financial picture. There's no way around it. So are you seeing that as well, Dave? And I guess where rates are concerned, and I know we want to touch on the CPI data too, which is all kind of parcels into this, but do you think we're heading into kind of a more consistently like high rate environment, kind of in that 4.5 to 6% range? Or do you think we will see rates balance out closer to that, 3.5 to 4.5% range long term?
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Even the best photographer can't hide drywall dust and paint splatter. And every day you delay listing could mean missing peak spring pricing in Ottawa. A to Z Cleaning Expert gets your property truly photo ready. Don't risk going to market half ready. Mention TOREP at atozcleaningexpert.com to receive priority scheduling for your next listing. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal.
I think we'll see them come back down from where they are now. I think, my thought and what I've also been reading is kind of in that range of where we were before this, this oil crisis, if you will, and this conflict in the Middle East, where they were basically 2.5 months ago, where and I have some clients that are closing in this week where they're 5-year fix at 3.79 because we locked it in 10 weeks ago or 12 weeks ago that, and I said it then to them as well, those same clients, this is likely to be where fixed rates are going to be in that like mid to higher threes. And they're probably going to stay there. Like that's what they were in 2018 and 2019 as well. As we entered into 2020, they were in the mid threes and started coming down when COVID hit, but like in just before. But that's where they, that's kind of where they rest around. So I think they'll likely come back down to that range. How long that'll take, who knows? Because we have, right now we're at a 52-week bond yield high for the 5-year government bonds, which are what the fixed rates are based on them. So at a 52-week high, that's why we're seeing rates back to being a 52-week high as well. And we're going to see them increase again this week. We got some notifications Friday night of some lenders moving at midnight. The CPI data today is positive. So it's perhaps we'll start hopefully we'll see it come down a little bit as we're looking at this live data. It still hasn't budged yet. And we're 10 a.m. on the day that this CPI data came out, which was very positive. That should have, pushed it lower, but the market's not reacting. And that's a byproduct of us being so closely tied to the 10-year US Treasury that isn't bumped up, and the global bond market that's bumped up. So I think we will in time see it come back down, but it's going to, again, we need this conflict to ease. We need oil to, kind of start flowing again. I know there's been, this past weekend, there was some announcements in the Middle East of the UAE building, they permitted a new pipeline that they're going to just bypass the strait. And so that they're not relying on it moving forward. And I think we're going to see, we saw over the weekend as well in Canada some movements in BC about a pipeline. I think that this conflict can also change the dynamics around the world of how oil and gas distribution is, which will become less reliant on one area like we're seeing right now, which I think will be for the better. And, that in future conflicts, we're not seeing a chokehold like we're seeing right now that's bumping up everything and causing disruption globally. But, I think it'll take some time. I think they will come back down, but I think it'll take a little while. But to that point, today's like the April inflation numbers came out, and it was actually good news. But like I kind of alluded to, the bad news is really in the global bond market. So, the numbers were looked at were very positive. They'll be looked at from the Bank of Canada in a very positive way. Really, as we lead into that June 10th decision making, rate decision time, even though, so we saw basically fuel, like I was mentioning, come up 19%, 19.2% increase in fuel costs. Our CPI headline number came in at 2.8, where the market expectation was 3.1. So that's a pretty big difference in what the expectation is to what it actually came in at, and why it's a little surprising that the bonds haven't come down, but that's being driven up by external factors outside of Canada. The CPI trimmed mean came in lower as well. Came in at 2.1. The previous was 2.3, and the consensus was 2.2. So we're at a 5-year low right now. The CPI median, again, came in at 2%. The previous was 2.2, and the census expectation was 2.1. So all great metrics, and three key measures that they're looking at, that the Bank of Canada will look at. So we didn't really see any big spikes or anything like that, which is great. So inflationary details, the increase to 2.8% from the previous month's 2.4% was, attributable to the disruption of oil supply, like I was mentioning in the Middle East. But again, it wasn't as high a jump as we were expecting, the 3.1, or the market was expecting, I should say. So they haven't seen it kind of ripple through the economy as quickly. Couple of key metrics: transportation inflation surged to 7.6%, or from 3.7, and that was again based on that 19.2% surge in fuel energy pricing. It was at 3.9 in March. So, we kind of saw, some others. We saw food purchased by stores increase 3.8% year over year. It was a slight deceleration from 4.4%. So shelter costs grew 1.8% year over year, but rent price growth slowed nationally to 3.6. But BC is seeing the sharpest decline in rent increases. Travel tours, they fell 11% year over year, which was kind of interesting as well. But as I was kind of mentioning and talking about, we haven't seen the Canadian 5-year bond yield drop, this morning, and we've really been seeing it rise. It rose almost 0.5% in the last week and a half, basically since our last show, unfortunately. But it was influenced heavily, like I said, on the 10-year U.S. Treasury, but on the broader global market. We haven't seen, like I said, that the inflation kind of translate into the good news on the inflation translate yet into the 5-year bond coming down, but hopefully as the day kind of keeps going, we will see that. Was there anything in the numbers that you kind of read this morning? I know obviously all of this came out basically as we were coming on to record, but is there anything in there that, or are you kind of the same as me, that it's kind of surprising where all the numbers are at?
Well, I mean, obviously the headline number being better than expected is good. So that was, I guess, surprising. You know what I mean? Typically, usually worse, at least like recently it's been worse than we expected. So I think it's good that it's trending in the right direction. Now, if you ask the average person, like, do they think things have become more affordable or cheaper? Like, no, like you said, like oil, like, you go to the gas pump and you're paying $1.86 a gallon or a liter right now. Like it's absurd, compared to we were at $1.09, 3 months ago. So, I mean, I think we're feeling it more. Like, loaf of bread is $5 now. Eggs are $7. Like everything is expensive. So it's not like, it's great that all these numbers, like the headlines sound great, but for an everyday Canadian that's out trying to, keep a roof over their head and feed their family, I wouldn't say things have become more affordable or cheaper or more manageable, you know? So I think this is all great, but at the end of the day, like we need to do better, I guess, as a country, as an economy to allow Canadians to get back on their feet and kind of, you know, make things more affordable for everyone, not just headlines and shelter. You know, rent has come down, which is great, but I think all of this translates into, again, like oil prices, the carbon taxes, things like this just create additional costs for Canadians, and it forces the companies to add to their bottom line as well, which then is passed off to us as consumers. So we're kind of paying the brunt of it, and at the same time, our taxes are also increasing because they're adding more money to go into the economy itself. So it's like our money is worth less, things are more expensive, and our taxes are higher. So like none of this is benefiting us on like a day-to-day basis as Canadians. So I think like the numbers, like it's good that it's positive and it's trending in the right direction, but like we have so much work still to do, you know, and there's so much opportunity here that I think we can do better than we're doing. That's all I'm saying. You know, I think there's lots of opportunity here to be a very strong economy and to turn Canada around from where we are currently, but we're not there yet. And I don't see writing on the wall that says like, wow, Canada is going to be booming in 6 months. Like I feel like things are not trending in a great direction. I'm thinking about this just from like a very macro level as far as cost of living, like rates, everything really, just like the overall manageable life expenses are rising day to day, and our dollar's basically not worth as much as it was. So all these things are not ideal. Now, I don't want to be too doom and gloom here, Dave, before we roll into the mood boost. But that's just my opinion. Like, I just think that we could be doing a lot better and we could be making life a lot more affordable for Canadians versus what we're currently doing, you know?
But I think that's kind of a sentiment by a lot of the general public as well. Like, you know, like you kind of said, that these headline numbers of 2.8 versus 3.1, like that doesn't, you know, to people that are looking at the economics of it or the market, like that's all great for, you know, but when you speak to an average renter, an average, you know, person in their 20s, 30s, at any age, actually, to your point, like they would say that things are more expensive because every week they're filling up their tank of gas, and those Honda Civics that used to be like $60 to fill, they're now pushing $100 to fill a tank. Or, you know, or higher, you know, and so that eats into what people can save and how they feel comfortable. And so the thought of being able to afford things on a day to day is kind of being stripped away, if you will, let alone the ability to set aside a little bit of extra money for savings, you know, whether that be for a rainy day fund, whether that be for a kid's education, or whether that be for a down payment.
A travel tour.
More challenging.
A travel tour. Right?
Yeah. I mean, that speaks to it too. Like that being
11%.
them being down, it being down 17%. Like that's telling. Like people aren't spending on those luxury items as much as they were, and it's obviously a byproduct of how the greater local economy is doing, right?
Completely agree, David. Mood boost?
Well,
should we slide into some mood boosts?
I was going to say, perfect. We'll just get everyone down and then boost them up.
That's what we do. We start positive, we hit the negative, and then we hit them with some mood boosts. So here we go. I got 3, and one of them's so topical, it's hilarious. Number 1, Dave, why are balloons so expensive? Inflation. You know, inflation.
That's good.
Number 2, why don't phones ever get hungry? They got plenty of apps to choose from. And last but not least, number 3, I have a fear of elevators, so I'm taking steps to avoid them. Yeah, not bad. I like them.
Not bad. Not bad. I'd say 2 for 3. I'd say 2 for 3.
Yeah,
I mean, maybe even 2.5, maybe 2.25.
2.25. Wow, just like we're pushing. Let's get inflation to 2.25. Let's get inflation to 2.25. We'll be all set. Thank you, everyone, for tuning in, and thank you as well to our amazing sponsors. Thank you to all of you for listening. New episodes are released every Wednesday at 10 a.m. Most Wednesdays at 10 a.m. And you can follow us on our
most of the time.
You follow us on our socials, and we have exclusive content on there. We thank you all for listening. We'll be back next week. Spring has sprung. We're here. Summer's back.
Deuces.
See you later. Bye.